you still see so many of these traders just camped out on the lower time frame, loss after loss, funded account after funded account. I have zero doubt what I am about to launch will change Falcon forever. H4 Mastery, I have just wrapped up and finished everything. Friday the 30th of August, the community's got access to H4 Mastery. If you want to increase your win rate and you want to decrease your drawdown, you need to understand H4 Mastery. I've been working on this for over a year. There is a reason why when you understand H4 Mastery, your drawdown will decrease. There is a reason why you will increase your win rates, because the accuracy is there. It is difficult and virtually impossible for you to miss a lot of these trades. No longer are you going to be camped out on the lower time frames, stressed out and anxious while you keep getting in drawdown in London session, in New York session. There is a much better way, there's a much more efficient way that doesn't require you to be glued to the screen. There is a way that you can trade with freedom and flexibility, so no matter what you're doing, what your job is, you're still able to capitalize on the financial markets. Let's be honest, most traders that trade on the lower time frame don't really make money. They fail to get consistent. They find it hard to have any long periods of consistency. I don't blame them. It's really, really noisy. Only a very small percentage of people can pull it off. So what I think traders should prioritize is a strategy that doesn't necessarily not have lower time frames in it. Lower time frames are fine, but they should turbocharge what you're already doing. It needs to have a high time frame narrative, if you value consistency, that is. And the prop firm data has shown that for years. So I think that the industry has genuinely started to wise up now and realize that, yes, it was good for a period of time. However, if I want longevity, if I want my life to be less stressful, I don't want to be glued to the screen, I don't want a super low strike rate, I don't want to be hoping for that home run trade that gets me out of drawdown, well then I need something that has higher time frame backing that is really simple, mechanical to follow. This is why I created H4 Mastery. Been working on this for over a year, and it is launch day. Couldn't be more happier with all of the content, all of the material, knowing that, bearing in mind I've been drip feeding some of this content over the coming weeks, the impact is already there and it's just come out. So I'm really looking forward from now until the end of the year, the dramatic impact that we're going to see on funding and all these things. And with that in mind, I wanted to give you not so much a sneak peek of the strategy, because we're not going to be talking too much about entry criteria now, but more of the understanding. I think this could be really valuable for you guys, because I get a lot of messages about trading, about our strategy. Can you show me this? Can you show me that? Listen, this is all in the content. You want to invest in yourself, the link in the description, it's always there for those that are really serious about this. Nothing in life that you get for free you truly value. Nothing. If you really think about it, the things that you get for free gem membership, you won't go to it. There's a certain level of having skin in the game that makes you do the things you need to do, because you know, right, I'm investing in myself. I need to make this work. Just how I've become successful, it is no different. But there's a questions I get a lot, and I think this could be very, very valuable. I'm just going to show you on the chart here as to the fundamental problem that I see with most strategies. So this is why I believe that H4 Mastery solves that, and you'll understand why. So let's take simple chart. Let's say we've got a high and we've got a low. So swing high, swing low. Let's say this is a daily range. If you are under the impression, we'll talk about market behavior, because what we're really looking at is repeatable systems, repeatable market behavior. So let's say we can agree, and I think most strategies do actually agree on this concept. Let's say that you've got momentum into the market and price just leaves an area of consolidation, volume, whatever you want to call it, right? Liquidity, etc. And then price leaves that area, breaks a low, breaks a structure, whatever you want to call that. And price comes back up into that and will gap between it. This is what we refer in Falcon a near miss. Price will near miss areas where there's sharper volume, where there's a lot of players, bigger players stepping into the market. And then what will happen? Price will leave those areas, and eventually price is always seeking liquidity. So we'll seek that area. So as we seek that area, that is our most valuable point in which that we want to get in. Because why? We want to get in because we know that it's more likely, this is probabilistic thinking, it's not 100%, but it is more likely to position yourself above here and stay in your trades, because bigger players are gravitating towards where the volume is. So if the market is seeking that area, wouldn't it be wise, if you want to ride that wave, if you like, wouldn't you want to get in those areas to make sure that you're in in rhythm with that. You're on those waves versus fighting against that. So this is something you can test. You can test it over 10 years, 12, 15, 20, 30, 35 years. You can test my theory. That's completely up to you. But this is a repeatable system. It's repeatable market behavior. Now, are there going to be variables within that mechanical thought process? Of course, and that's where a strategy comes in. You need a strategy, right? There's concepts and there is a strategy, right? So this concept has always been alive, in which the market is seeking to break highs, break lows. So what you also find in these sharp areas, price will break above and it will come back in. And then as it comes back in, because again, getting people caught on the wrong side, trapping people into long, say for example, this is a strong area of what people would see as resistance. They'll see it as respect. And then where you've got the amateurs, in my opinion, if you're very limited in knowledge, you're looking to just get long off of random, supports, resistance, etc. They have their place because essentially the market is always seeking that. However, this is where we would actually look for the market to not go long. We would actually be anticipating a short. And we see this repeatable behavior over and over again. What I'm saying to you is this. If we can agree just on that even basic concept of the market repeating something like that, what other variable do you have to consider? Where the price action is. And this is the problem that I've identified for a long period of time where I see the issues are. You will take something like that and go, Mark, that is no different on the 1 hour time frame. It's no different on the 4 hour, on the daily, on the 5 minute, on the 1 minute, and you'll think it's exactly the same. In a fractal in that sense. Most of that is true in the behavior. But the one thing that people are not thinking about is risk. At the end of the day, what's the holy grail really, truly, to being a successful trader? It's not necessarily the strategy, is it? That's one part. There are garbage strategies, and there are, of course, better strategies. But what is the key to keep you in the game? Risk management. All the veterans talk about that. Risk management and a competent mind. If you have those two, if you've really worked on your mind and you've got great risk management, it's really difficult for you to blow accounts. So don't wear it like a badge of honor saying that you blew loads of accounts. No, you was terrible at risk management, because the chances of you blowing all of that money on, and you was risking, let's say 1% per trade, you'd have to be a pretty unlucky trader to not even by accident come into some wins. So yes, you had poor risk management. So if you've got good risk management, really strong, competent mind, you've got the composure to execute that edge, and you're controlling the risk. So that's a good part. What about the quality of the risk of the individual trades? So this is the part people are not understanding. And I'll show you here. So this is, take $1 for now. I'll show you on any pair. Same thing. Let's say that we approach that same behavior of this structure here, right? So as you can see, there's your high, this breaks that high, this doesn't break that low. It's the same theory that I just spoke about, right? So look at the gap between there. Let me just put a ray line on. So there's your gap. There's your gap here. So price is eventually looking to fill that. The same way, you've also got price looking to fill this gap right here. So if I go to the left, there was a lot of volume that was built up there. Prior volume there as well. What do? Retest the back end of that structure. Notice how that you've got the gap here, but then you've got this high that takes out this high, but still leaves that gap. What happens? We eventually take out this high, we break above, and then that's when the bigger volume is stepping in. So now you understand the bigger picture idea. So where does the example come in that I just explained to you? So if that behavior is correct, do you think, honest question, do you think, and then now you'll understand why I think a lot of strategies that will trade these concepts with like liquidity, etc., they're on the right path to a degree, but they get involved in a lot of noise. So they take some good trades. You might even find themselves having some good months, but then there's always that period of like -8, -12, -15. They go on excessive drawdown. It's very demoralizing. So I get that. It can be stressful as well. But what happens is they don't factor in the risk of the trades. So my question to any of you, especially if you're curious about the way that we trade, do you think that the risk of the trade here is the same as here? That's a genuine question. It's not a quick trick question. Do you think it carries the same risk? If the market behavior, if let's say, again, as I explained, leaves an area, moves up, gap, comes up, maybe tags that area and then goes, that same behavior, that repeatable behavior that has existed for over 3 decades, right? Call it that. Does it carry the same risk down here as up there? You answer that question. I'm giving you the clues already to figure out a lot of your rubbish trades. And I know this because I've looked through so many journals of those trades, and it's the same thing over again. Too zoomed in, take some decent trades, then just poorly positioned. And that's why we have a PSE model in Falcon. Really simple: position, sequence, entry. You need to know what that means in a bit more detail, but positioning of the trade is crucial. So now when you factor in a run like that, the behavior, you look at the risk, you can look at a few things, right? Risk model. So let's say, assuming you're risking 0.5% per trade, or 1% per trade, or even 2% per trade, whatever your risk model is, then it's going to be, well, where are my trades positioned? Because what if you were actually onto the right idea, but you were trading into key lows, you were trading into profit-taking lows, or you were trading into highs, right? So you're so zoomed in, you can't possibly see that because you don't have a high time frame narrative backed by how you're trading. So if I zoom in here and I blow the chart up, and let's say we go even into the 5, I can show you the same sort of behavior, right? Same sort of behavior all the way through. However, even if I just zoom into anywhere, if I zoom into that, yes, I can find similar behavior in the market across the board. However, like even just this piece of price action, you've got the high there, same thing, right? This low gets taken out. There's your gap. What happens? And this is a random piece of price. I want random piece of price action. I actually wanted to go further back, but this is an example of like I've not picked it. See this high takes out that high, but leaves the gap. Eventually, what do? Break above the high, and then we go. So yes, I could show you that and go, listen, this is your entry. Let's break the high. You got your rejections. You can put a limit order, or you can wait for a rejection, whatever, right? Let's say you got in there. You can go super tight stop. Let's say you 5-pip stop. I could show you. This is with the Falcon system, right? I could show you that and then go, right, target 3.2. You'd go, yeah, job done. Easy money. Yes, until it's not. So that might work in a small period of time. But then if you zoom out and I go to, let's see, the 4 hour, like so, that had broken a high. Look at the amount of momentum that is in there. We're just starting. So I basically started selling off of the back of unconfirmed momentum. That literally just could have moved sideways, gone anyway. The momentum started to kick in. Then we started to confirm it. And the real quality of trades are in the run itself. It's not in trying to catch the top or catch the bottom. It's once we start getting confirmation, then you start looking for lower time frame entries in here, in this run. There are plenty of trades within this run. But you zooming in, I could talk myself into any trade and be like, oh, this is a high quality trade. And this is the issue. You don't look at sequence, you don't look at positioning at all. So if I'm blowing up all these charts and I'm too zoomed into the lower time frame, yes, of course, I'm going to overvalue lots of things. And it's going to work for a period of time, especially when you have a robust system like this. But then when you keep doing that and you don't factor in where the trades are positioned whatsoever, you will eventually go on a painful, horrible period of drawdown. And it will just be like, but I'm doing all the right things. And this is a common thing that I see in lots of different strategies that they send to me. Because I'm like, right, you're actually doing quite a lot of the good stuff, but there's always this period, it's just like loss. And when I looked at them, and I looked at these, and I don't even need to know the entire strategy, I would say a good 85% of the losses are all just really poorly positioned. So again, that's a clue. That's some free value right there. Just really poorly positioned. So I just wanted to explain that lesson because I think that could be super valuable to you guys that are just going round and round in circles and wondering why these things are not working. What I'm interested in now, this next phase of what we're doing, because of course we've just secured more capital allocation on funding, especially over these last 60 days. We've had so much more capital allocation on funding. We've got Dubai at the end of the year, Yacht Mastermind. We had the Wealth Creation Mastermind last year. We're literally just moving forward. Now, a lot of you guys have been trading for a period of time and not seen much success. There has to come a point where you realize strategy is really good. And listen, and I'm launching a new strategy. Strategy is really good, but it needs to be well-rounded. It needs to be everything. It's a multifaceted career. You can't just focus on one thing. You have to focus on everything. So of course you need a good strategy, and of course you need a good mind. But the one thing that you need to understand is it wouldn't matter how much mindset training I gave you. If I gave you this update and said, by the way, it's got a 28% strike rate, for example, and when it wins really big. There is an element of, no matter how good your mindset is, if your strategy encourages you to be emotionally distraught, it doesn't matter what training I give you. Yes, you will have a more calmer mind and I will be able to do a lot of work with you, but there comes a point that I have to rely on the fact that you could go into 8 losses before you win. So to me, like, you're already setting yourself up for just emotional volatility that you just don't need. There is a more efficient way that has a higher win rate, less drawdown, less likely to miss trades. This is what H4 Mastery is. So whether you're trading with a full-time job, whether you travel around a little bit, whether you can't get to the screen, whether you find yourself in a country where you're not trading in the best session because of where you live and you're always missing positions, it is virtually impossible for you to do that with H4 Mastery. When you master this time frame, so many people are obsessed with mastering lower time frames. I would say most of the people, they need to master the higher time frames, right? H4 Mastery. This will be one for the history books. I'm giving you some serious lessons here. Enough is enough. How much longer are you going to wait? Are you willing to waste another year, another 2 years? Can you even afford to get to the end of this year? Genuinely, can you afford to get to the end of this year and still be in the same position? You either get involved, you don't want to get involved, that's entirely up to you. I've given you some valuable lessons that I know could be super helpful for you. Hopefully it gives you some clarity, but I'm just very passionate about this, guys, because I see so many issues in the industry, and it's painful for me to look at, again, journal after journal, see like really simple fixes that I know that our system can do for most strategies. And if you just approach it with an open mind that maybe the higher time frame could be of value to me, maybe trading a few more instruments so I'm not forcing trades when the market's going through a squeeze, that could be of value to me as well. I promise you, more results are on the other side. This one was a beautiful position. So many people caught this trade. Again, simplicity, understanding where the higher time frame is in, way more relaxed, set and forget, being able to set these trades, leave them alone, let them run. The last thing I want you to remember when you got into trading in the earlier days, if you received any wisdom whatsoever, you would have been told that amateurs buy the highs, they sell the lows. You also would have been told that amateur traders, they don't cut their losses. And what do? They add to their losing positions and they don't let their winners run. So they don't even allow the winning trades to fully win, and it skews their edge. And then what do? They add to losing positions. They move their stop. So you need to put yourself in a position by understanding this is what losers do. This is what they've consistently done over decades after decades. This is the psychological mindset they're in. These are the consistencies that they follow. This is the type of behavior they have. This is their way of thinking. And how do I put myself on the complete opposite playing field of the way that they think? Because that type of money is consistently losing, and you owe it to yourself that someone has probably put in countless hours, hundreds if not 1,000+ hours into this. You owe it to yourself to do it in a much more efficient and less stressful way. You still see so many of these traders just camped out on a lower time frame, loss after loss, funded account after funded account. I have zero doubt what I am about to launch will change Falcon forever. There is a way that you can trade with freedom and flexibility, so no matter what you're doing, what your job is, you're still able to capitalize on the financial markets.